Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're having a great day here. I appreciate you watching. We're financial advisors that focus on education. And so every week we do classes for customers and we try to teach them something new, either about investing or personal finance, things like that, in really great detail for them. Well, I like to teach, so I'm going to share something with you here today that maybe you didn't know before, maybe makes you sound a little bit smarter around your friends, your parents, grandparents, whatever it may be. Let's see if we can help you out a little bit. So, have you noticed that the Federal Reserve cut rates? Got a lot of questions on this because the Federal Reserve cut rates and the 30-year mortgage rate actually kind of went up, right? What's the deal? What happened? Fed cut rates. I thought we would, see the rates come down, right? So a lot of people are asking me this question. Well, in the long run, historically, when the Fed cuts rates, eventually mortgage rates come down. Your credit card rates, well, initially come down. Auto loan rates come down. Home equity lines of credit, they tend to come down, although if you pay attention, they have a little bit of a floor in the fine print there, so they can't fall but so much as sort of protection for themselves. Sneaky. Anyways, the 30-year mortgage rate is actually trending higher. And so people are saying, what's the deal with that? Let's go over to the charts here so I can kind of illustrate this. Makes it a lot easier than staring at this face. So you got the 30-year mortgage rate. You got the Fed down here in orange. So the Fed has cut rates now twice. The last rate cut, they went from 2% down to 1.75%. And I did videos on this in the past to kind of explain, what does that really mean? Like, what's going on there? How does that affect me? But today is a different topic. So the Fed cuts rates. Look what happens. Here's a 30-year rate. It starts ticking higher. Worst case, we could say it actually has been going sideways since they started cutting rates, right? Go all the way back here. It basically hasn't done much. But in the ultra short term here, as they have cut rates, mortgage rates have gone higher. Why is that? Right? That doesn't really make any sense. Now, in the long run, they will pull down eventually, especially if the economy weakens. But in the short term, rates have gone higher. So people that are like, oh, the Fed cut rates, I need to go buy a house. Wait a minute. Not so fast, right? And to kind of explain this in a super, super simple way, let's pretend I'm the bank. I'm going to loan you money for 30 years. You want to buy a house? You got it. Whatever you need. $500,000 to buy a house? You got it. But I just noticed that the Federal Reserve cut rates. So when the Fed cuts rates, inflation tends to increase. Why is that? When the Fed cuts rates, they're enticing you to go buy more. They want you to get money out of savings because you're not making anything, go invest it or go buy more stuff. If you can buy more stuff and we all have dollars to buy stuff, the price of stuff goes up, right? So as me, the bank, realizing that when the Fed cuts rates, inflation tends to go higher, or at least the Fed is signaling to me that they're okay if inflation goes higher because they're cutting rates. So because of that, me, the bank, I'm going to go, okay, let's think this through. I let you borrow $500,000. For 30 years at a fixed rate. I can't change it, right? So as you're paying me back, if inflation goes up, the value of the dollars you're paying me back is less than what I had anticipated, right? So I've got to account for that somewhere, and I account for that by keeping my rates a little bit higher, right, uniformly. So the bank's essentially saying, okay, the Fed told us there's going to be inflation. They're okay with it. They want it. They want it to go over 2%. And that means that the dollars you pay me back are going to be worth less. I can't have that because I got to report to my shareholders. I got to make a profit of some kind, right, as the bank. And so the banks keep the rates higher, right? Let's take a look. So let's dive in a little bit further here. You've got rates moving just a little bit higher here in the short term. Let's go back to the last time the Federal Reserve cut rates and look at inflation. Now, first, I'll start by putting inflation on the charts here. This will be your blue line so you can see what's going on. The Fed desperately wants it to be over 2%. They're having a hard time doing that, so they cut rates hoping you'll go spend the money. If inflation ticks higher, the banks have already accounted for the possibility of inflation going higher. Still with me? All right, let's go back to the last time this happened so we can show sort of how this works. 2005. So we got the last time that there was a real significant rate cut by the Fed. Again, that's your orange line there. If we were to kind of look at the 30-year rate as the Fed cut their rates, look at, they go higher, right? For a period of about, 8 months to a year, they go higher. So banks were assuming more inflation. Banks were correct. Inflation actually went higher. That's your blue line there. So you got an increase in inflation. They were locking in that spread between inflation costs and, of course, the profit that they hope to make from you there. So that's what you have, right? And because of that, you got a short-term rise in rates. And for a while, interest rates actually didn't do a whole lot. It took a while, and of course, an economic basically collapse, to get rates to really start pulling lower. So that's just sort of a quick way to look at that if you want to go back and see. Now, I think I can go back even further. Can I go back even further? Yeah, kind of. So I'll go back here. What is this, like 2000 or something? Yeah, around 2000. Fed starts cutting rates. Actually, inflation didn't tick higher, but look, mortgage rates didn't do anything for a while. If you were to draw a straight line here, they're perfectly sideways inside of a range before sliding lower. What does that tell you? Well, when the Fed cuts rates, if you don't see an uptick in the price of mortgage, 30-year mortgage, you usually see it move sideways. It tells you there may not be any hurry if you're trying to cherry pick the absolute bottom of the best point to buy a house, right? Overall, rates will tick a little bit higher, but now that answers some of the questions. Why on earth is the 30-year mortgage trending higher, at least in the short term here, if the Fed just cut rates? Now you know. They're just keeping track of their dough, just like you should be, and just like we help all of our customers here at Jazz Wealth by doing the weekly classes, helping with the planning, any sort of assistance you need. We are like a full financial advisor investment company, but we don't care if you only start with a small balance. We don't care if you're a millionaire, and we don't care if you only have $1,000. We're going to help you either way to get your dough straight. So I hope you'll check us out at jazzwealth.com. I appreciate you watching. If I helped you in some way today, maybe you'll hit the subscribe button or the thumbs up. Thumbs down's okay too, I guess, if you really didn't like what I said, or if I messed up something along the way. It happens. But you enjoy the rest of your day. Enjoy.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.